Well, hi everyone, and welcome to the week 4 webinar for the InvestSMART Bootcamp. And this module 5 and 6 is being covered in this last week of the week 4 program. And as you probably know, you can always come back to any of the webinars that we've done, because what we'll do is we'll upload them straight after the webinar goes live each week. So you can take as long as you want. You've got 90 days to access this content on Bootcamp. So definitely make the most of it, and you can come back to it as often as you want within that 90 days. I'm Tom Wilson. I'm one of the portfolio specialists here at InvestSMART, and I also look after the Bootcamp. So let's get started. As always, just the disclaimer there talking about we can only provide general financial advice only, not personal advice. So these webinars, like the other 3 that are before this one, they're basically designed to cover off any additional questions that you've got from the learning material. So as you're going through, if you come across a thought that pops into your head and you wanted more info on, or if you're stuck on a certain area and needed more general language just to get you through it, as opposed to some long financial terms, this is the best place for it. As we mentioned, we don't give financial advice. If we get any questions that are of a personal financial nature, what we'll do is we'll try and reword it, or maybe get into contact with you after the webinar's done. So we'll try and stick to the course content, which means we'll try and stick to the content covered off in module 5 and 6. But if questions do pop up, I'll do my best to try and incorporate them into this webinar. And on the right hand side, you can ask questions as we go along, or even comments as well. So definitely make full use of that. And as you probably saw when you've signed up for this webinar, you can actually pop in a question there as well. So if you can't make the webinars live, definitely put in questions before the event happens during the registration, and I'll get to them while we're going. You can always email them at bootcamp@investsmart.com.au as well, and I'll take them there at the same time. It's also just a way to make sure that you're using the available resources. So you've got 1 month's access to both Eureka Report and Intelligent Investor, and they've got so much knowledge in them, it's definitely worthwhile. And always remember, this is an introductory course. It's not a first-year university course, which means that we won't go into too much technical detail. So no equations on how to calculate options or bonds. It's basically just covering off the basics. So I think it's always good just to have a quick recap of what we've covered off so far. And in week 1, we looked at the investment planning process along with diversification and allocating assets. So we worked out that when we're planning, we need to have a goal in mind. So I always use the example that I'm saving for a house deposit. We need to know the time frame. So how much time do we have, or how much time do we need? I have realized that I need about 3 years to do this. So my time frame for me is 3 years. And then we need to understand what risk we're comfortable with. I'm fairly comfortable with risk, but as I'm saving up for a house deposit to get a home loan, I don't want to go backwards. So I don't want to have less than what I started with. Diversification is basically how you want to spread the risk. If you put all your eggs in one basket, that's a very risky option. Whereas if you tend to spread them across different assets, that's going to reduce that risk for you. And that comes down to the assets. So what percentage do we put into each area? And that's based on the time frame again. So if you're someone who's got a very long time frame, you might want to have more of your assets or more of your cash or investment maybe angled towards a bit more higher risk, but also usually higher return as well, like equities. Week 2, we actually looked at the investment vehicles, or the things that you can invest in to achieve your goals. And we looked at shares and ETFs that they usually trade on exchanges. And we looked at managed funds and managed portfolios. So having someone else look after your investment for you and investing through that method. Then cash and bonds, which is usually a risk-free type investment that's fairly defensive. The week 3, always a bit of fun. It looked at strategy and we explained active versus passive investing, the core and satellite approach, which is quite popular, value investing, technical analysis, income and strategies related to that, and also the perils of market timing. So if we have to sum it up, what do we know so far? We definitely push the message that we know we need to have a plan. So we need to have a plan of where we're going, what we want to achieve, and how we're going to get there. We need to know what we can use to actually complete that plan. So what are we going to invest in? What kind of investment types? What kind of vehicles are we going to use to get there? We need to understand the costs involved. It's not good putting all your money into something that has a very high uncapped fee. That's just going to eat away at any kind of potential growth that you're trying to achieve. But again, you have to understand the risks as well. So if you've got a time frame where you've only got 3 years, like myself, for example, for a short-term goal, you don't want to put it into something that is high risk, potentially high return, but in that second or third year, you have a negative year and you go backwards. We also know that there's different strategies. So we talked about the bucket type strategy. That's fairly useful for the retirement phase in particular. But we also talk about having the core and satellite, where at the core, you have a passive investment, one that's basically not trying to outperform the market. It's just going along, getting a return each year and growing. And then on the satellites, so the branching off that core, you've got little actively managed or active type investments. So one of them could be investing into a fund that's actively managed, like the Intelligent Investor Growth Fund that they launched a couple of weeks ago. Or you could have a pocket of your own shares that you choose yourself based on your own research or research from Intelligent Investor, again, that might talk about buying and selling recommendations. So week 4, so this week we're looking at investor psychology, and also we're looking at the next steps to take. So usually a lot of people who've gone through the bootcamp, they've gotten this knowledge, they understand these are the basics of investing, this is the things I need to look out for, but often they have asked, well, what do I do with this knowledge? What's the next step? So this is more of putting it into a practical application for you. Investor psychology. So it's basically looking at what is holding you back from pulling the trigger. So something that's stopping you from investing. We look at what also tempts you to invest. So perhaps times when you shouldn't make an investment choice. We also look at the biases behind that. So there's a number of them, and as humans, we do suffer from quite a lot, but that's something that we all have, or most of us have, I should point out. And then we also look at the common mistakes that a lot of investors and traders make. So with what holds you back, is it a case of missed opportunities? So sometimes you can sit there and not want to jump in just because you don't have all the information, you're uncertain about what might happen. There's always going to be uncertainty. There's a really good quote from Warren Buffett in the course content where he's talking about different events where people are uncertain. And then he goes to show that there's another event and another. And I guess we're going through that right now with the COVID pandemic. And that's been an interesting ride for this year, for 2020, seeing the market drop down and then recover as, I guess, uncertainty is slowly wound back. And again, that's just in Australia, but then you've also got the international consequences as well. So how do you try and conquer this uncertainty, this holding back, if you will, of investing? Well, again, it does come back to a plan. When you write down your goals, your time frame, and even talk about risk, it helps to put your thoughts onto paper, but also gives you a structure that you can follow as well, that you can come back to for reassurance as you're going through. It's good to stick to your plan, if you needed to make tweaks as you go through, that's okay, but just don't do dramatic changes where it defeats the purpose of having a plan in the first place. So a lot of traders I used to speak to, and I used to work at a broker, they would talk about when they would have a loss, that was one thing that would really put them off investing for the next time or trading for the next time. And unfortunately, losses are part of the game, particularly if you are choosing individual shares or individual assets to invest in sometimes. It's part and parcel of the investing world. Unfortunately, not everything will go up, but if you have a plan for it and you can plan for the worst case, perhaps even there's a technique which is called negative visualization, where if you sit there and think, well, what's the worst that can happen? Then you can at least plan for it and be mentally ready for it. Writing it down is always a good step as well. A lot of the time, it comes back to having enough cash saved up and perhaps squirreled away somewhere else in a safer type investment, whether it's just cash at bank or something that is defensive, like a fixed income. That might be one method as well. I personally, I like positive visualization. I'm a fairly positive and optimistic person, but I also think long term. So I also have the view that investing is a long term game, not a daily type thing where you jump in and you watch your investments go up and down on a daily basis. I don't think that's a healthy thing to do. I think it's more of as long as you keep investing and you're in something that doesn't have high fees, it will eventually grow, and the benefits of the compound growth, compound returns, that's what will get you there. I'll just check if there's any questions. Feel free to interrupt me as we go and just pop a question in. I'll have a look at it for you. Basically, the second part is looking at what's tempting us. So sometimes there's people who, and I've done this in the past myself, where I'll jump in, I'll have certain trades or investments, and then I'll feel like, oh, I need to do this again just because I'm impatient. And what we found is that there's a lot of research where with overtrading, the people that will trade quite frequently, they'll tend to not perform, they'll underperform those who only trade when they need to. So what we're trying to say there is that there's this idea perhaps that with traders sitting in front of their computer screen every day, if they're buying, selling quite actively, the research shows that they don't tend to do as good as someone who puts their money in a certain investment that they've researched, and then that's their investment and they stick with it. They'll tend to do better, particularly over the long term. We are wired for this. So this is something that is very difficult sometimes. And there's various examples, like I think on Netflix at the moment, there's a show about social media, and it's tapping into exactly this dopamine effect. We're basically being stimulated when we do a certain action, and investing is particularly one example. So sometimes you don't want to miss the boat, but you need to sometimes have a plan where you can have a structure and follow it. And as long as you stick to that plan, that will help negate some of these temptations. I particularly used to see this a lot with traders who would have a number of either winning trades, and then they would keep trading for no reason. So they might have made their target for the day, and then they would keep doing it because they felt like they were on a roll, and they would have a loss that would wipe out their entire day's gains. There's an interesting YouTube clip by a gentleman. His name's Andrew Kirby. He talks about dopamine detox, about what you can do as well to essentially help give yourself a day or two off any kind of dopamine triggers that make us do certain behaviors. That's something that you might want to check out, or even look into dopamine detox just generally. So there's a number of different biases that we've got. And we go through a lot of them on the content themselves, but it's not an exhaustive list. There's actually heaps more out there as well. We just need to be aware of them, and there are some solutions written underneath them on the bootcamp website that do talk about what you can do to try and get around them. So the biggest mistakes that I've seen in my career in finance and investing, particularly working for a broker and even working with the InvestSMART Intelligent Investor investments that we offer, is that the people who don't have a plan, they're the ones that struggle. So they don't know where they're going. They don't know what they're aiming for. They will just put their money into something, or they'll buy a certain security and hope for the best. And when there are bumps in the road, like we saw during the COVID pandemic at the start of the year, around March, it can be quite scary. So you'll find that some people will think, I don't know what's happening. I'm just going to jump out of my investment. And what they're doing is that they've bought in at sometimes the highs, and then something bad happens, they'll panic and they'll jump out at the very low. Usually it's always timed that way. And they'll say they'll wait until the market goes back up to where it was. The problem is that even the experts don't know when the market will recover. We were definitely asked that during the drops that we saw at the start of the year. And we were fairly honest. We wrote a lot of articles even on the website saying we don't know when it will recover. If it's a long-term plan that you've got, it's a long-term process. You've got to stick with it and watch to see what happens. We also see a lot of people not record what is happening. So some people don't understand the costs that they're receiving or being charged, such as brokerage, or even they might forget about their investments, which can be a good thing in terms of a long-term type strategy, but they won't take into account any kind of management fees that are uncapped that they're paying. There's also the problem with diversification. There's a lot of people who think, and Australians are particularly fond of just investing in brand names that they know, such as putting all their money into Commonwealth Bank or putting into, say, Telstra, companies that they've dealt with their entire lives. And unfortunately, that's not really diversifying. It's not spreading that risk. It's putting it into one particular asset that if it has a bad day, your portfolio will have a bad day. The other thing we see a lot is being too conservative or being too aggressive in terms of risk. The biggest problem is that if I use an example, I had a friend who at the start of the year, because of the COVID pandemic, was retrenched and he received a payout from work, a redundancy package, but he'd also at the same time sold a side business that he had. So he came into a lump sum of cash, and he asked me, as a friend who's amongst the investing world, what should I do? My first question to him was, well, what is your goal? What are you hoping to achieve? And to which he replied, I just want to increase the amount of money I've got. I want to grow my investment. And that's a great answer. I said to him, okay, well, what's your time frame? And he said, just a year. I'm going to do it just for a year. That immediately puts it into a very difficult type situation, because 1 year isn't really long-term when it comes to investing. It's very short. That to me, straight away, I had to sort of say, look, the 1 year is going to stop you from doing anything too risky or too, it's going to limit your growth potential. You are sort of restricting yourself to defensive type assets like cash at bank or fixed income or certain bonds, or perhaps even term deposits. And the returns on those at the moment are quite low, which is just reflecting the low interest rate mentality all over the world at the moment. He wasn't too happy with that answer. He was hoping that I was going to be able to say to him, well, this is a product here that you can invest in that's 25% return just for this year. And he actually even talked about investing in certain assets like Bitcoin or other kind of cryptocurrencies, which unfortunately, they're quite risky. The other thing is being too conservative sometimes. There's some people who are a bit scared of risk. they have a long-term or a longer time frame, but they don't choose the right investment. So, for example, someone who might have a 5-year time frame, they could possibly handle more risk. So, putting it into assets that allow them to get a better return, but they might choose something that's super conservative, such as putting it into a term deposit. And you're basically leaving money on the table when that happens. You're foregoing any kind of better return. There's a lot of books written. These are some that I have told other boot campers as we've gone through this. The Dr. Alexander Elder is one of the first books I read. The New Trading for a Living, and The Trading in the Zone by Mark Douglas is quite good as well. Daniel Kahneman, who wrote Thinking Fast and Slow, he actually talks a lot about the biases that we cover in this course as well. So the next step, so this is, I guess, a bit more of the fun part. It's putting everything that you've learned into practice. So you might be someone who has taken this course just to get an increase in some of the knowledge and terms that we use when it comes to investing. You may actually want to invest on behalf of someone else, such as grandchildren. And we do have a question about that, which is fantastic, and I'll cover that off pretty soon. There's also the idea that you've gotten to a certain stage in your life and you're thinking, well, how can I invest now? Is it too late? How can I start to grow my financial part of my life? So again, it always comes back to doing a plan. So we're very big on having a plan. In fact, we've got free software on our website, and it's called the Portfolio Manager, or My Portfolio. And this is one of the best ways to get started. It'll allow you to enter in all of your assets or holdings, securities, even houses, for those of you who own more than one. And it'll allow you to see where you stand in terms of the investing world. You can then choose through the health check option a risk profile or a goal that you might have in mind, and it will compare you against that kind of portfolio or that approach and let you know where you fall short. So for example, a lot of Australians, they'll put in their assets that they hold, and they might just hold Australian shares. And this will tell you, you might need to look, if you want to diversify properly, you might want to look at international share portfolios. We can have a quick look, actually. I've got my InvestSMART website here up and running. And if I go at the top to my portfolio, I'll just click on this. And what you'll see here is that there's a test portfolio that I've set up. So you can put in hypothetical portfolios here, and what they are, this is one that we've set up in the office. So each of us get told to choose a stock that begins with a letter in the alphabet and see how it goes. So at the start of the year, we started off with $26,000, and this one just happens to have grown to $30,000. So this is by no means any recommendations. It's purely just me choosing stocks that begin with certain letters of the alphabet. I could go down to current holdings and actually see what they are. And if you've got any InvestSMART portfolios, so if you're invested with us, you'll actually see them at the top here as well. So it's a great place to track. But I'm going to go to shares, options, and ETFs. And this will show me what I'm invested in. So we can see that I've bought some ETFs, I've bought some different companies. And if you're signed up to the Intelligent Investor, you'll also get the recommendations here as well as part of the service. So that's handy to keep an eye on too. But you might have seen that there's the health check. If I click on this here, it'll take us to that section. Now, beforehand, I have entered in the type of goal that I am after, which is a 5 to 7 years growth. And it's comparing me to that kind of makeup. So that's the target here. As you can see, it's diversified. It has a bit of Aussie equities, a bit of international property, cash, fixed interest, and alternatives. At the moment, this portfolio is heavily and only in equities. And you can see there's actually some international equities there because Some of the companies I'm invested in, like ResMed, for example, it recognizes income that comes from overseas. So it'll automatically do this for you. So it's a great tool to use, and I can highly recommend it, particularly the recommendations section. So how do you approach the investing world? Like, what's your makeup? We'll talk a lot about the InvestSMART products, and that's pretty much because I'm familiar with them. I work at InvestSMART. Don't take it as a recommendation directly from me. There are a lot of different products out there, and we do have tools on our website that help you even look at other portfolios as well. But you might have an approach that you just want it managed for you. So you want to sit back on the beach there and relax and have everything done. In that case, you might want to consider looking at the InvestSMART portfolios that we've talked about before. Now, what these are diversified. So it's spreading you across different asset types already, so you don't need to worry about that. They're basically off-the-shelf type products, and they range from conservative, balanced growth, high growth, and each have a suggested time frame. So I was talking before about time. Now, for me, with my goal of saving up for a house deposit, I said 3 years. And if I look here, I can see, well, that's 2+ years. And this is 4+ years for balanced. I would probably myself be better off suited to the conservative. What this does is, if I were to click on learn more, it'll invest me into holdings based on this allocation here. So the majority of my cash, 46%, is going to go to a very defensive asset, which is fixed interest. There'll be 20% staying in cash, and there'll be a little bit going into equities, so about 23%. That's what's going to give me, I guess, dipping my toe into the water, the risky water, to try and get some growth. These ones have the capped fee model, so the minimum is $99. If you invest between 18 to 82,000, it's just 0.55%. But once you go a cent over $82,000, you'll only ever pay $451 per year. It'll show us the holdings as well. So what we do to get these percentages is we invest in these kind of ETFs on the side. And what ETFs do, it offers us a way to get exposure to that particular area of the market at a low cost. There's a question that we received before the webinar, and I'll just bring it up here. And it was from Rose, and she was just asking, relating to an earlier module on bonds, when or why would you invest in a bond ETF rather than purchasing bonds directly? That's a really good question. The biggest thing is, like you can see here, we actually use in our portfolios, we do use a bond ETF, and it has the ticker code of IAF. So that trades on the ASX. So you can go to a broker or even to Google, and you can type in IAF and you can see that price. Now, that's one reason why you would purchase a bond ETF. The fact is that it has transparent pricing. So they trade on the ASX, whereas most of the individual bonds that you can buy, they trade on more complex markets. So the pricing is somewhat not transparent, and you can have higher costs of getting in and out. That's the other thing with the ETFs. You can buy them through the broker, and usually the costs of the management fees inside the ETFs are quite low. So they're quite affordable. If you're looking at these ETFs as well, the bond ETFs, you're usually getting diversification. So within them, they're holding a basket of bonds, which that will improve the overall portfolio diversification, and it'll help to reduce the chance of you essentially lending, because that's what a bond is. You're lending to a corporation or to a government. It's basically reducing the chance that you're lending your money to a dud company. The ETFs also, they tend to track time-tested indices or an index, and they continually do better than active bond fund managers. So someone who's actively managing a bond portfolio. And I think a recent report, there's a 2019 SPIVA report showing that 81% of Australian bond managers underperformed the index benchmark over a 5-year period, which is what we tend to see quite often with these passive investments. So a passive investment is something that is not trying to outperform the actual market. It's just getting the returns that the market offers. So there's some of the reasons why you might look at investing in a bond ETF or even ETFs in general. So ETFs are going to give you better diversification. You can see here we've got the Australia 200. So these are the top 200 shares by market capitalization. If you were to buy that one ETF, that would get you fairly good exposure to the Australian equity market. And that's what we use in these managed portfolios. So basically, to sum up, these portfolios, they're off the shelf, which means that you choose them based on what matches your goals, time frame, and risk. They are automatically diversified. They are low cost. We cap the fees. To sign up for them, it's quite simple. You can just go through the website. If you do the portfolio manager, for example, and if you don't have exposure to, say, international shares, you can slot these in here. So these are some that you can put alongside, and they, of course, you can read more about them as well, but they also count towards that capped fee setup, which is fantastic. The Intelligent Investor, it also has investments that are actively managed. So if you're someone who wants it done for you, at the moment, you can buy through your broker, equity income, ethical share fund, equity growth. And these are actively managed portfolios where Nathan Bell and his team are behind the scenes each day researching, buying and selling certain shares that they think have growth potential. And then they're putting them into this fund, which then trades on the ASX as an ETF, exchange traded fund. Their goal is to try and outperform the market. So here they're saying they're trying to beat the ASX 200 accumulation index. And that's an index that tracks the top 200 shares with the dividends reinvested. So it's trying to outperform that. The fees aren't capped with active investments. They're 0.97% on your investment, and these come out of the ETF itself. So when we have some people talk about having a core and satellite approach to investing or strategy, they might have one of the InvestSMART portfolios at the core. So right in the middle, they might have a big chunk of it sitting there, invested in growth, for example. And then they might have, say, 10% or a different figure based on what's suitable to them in actively managed investments like a growth fund, for example. And Evan Lucas and I did talk about this last week in a webinar that you can get on Bootcamp. Otherwise, you can get it on the InvestSMART website under the events at the very bottom. There's the second option here where if you want to have a mix of both, if you wanted to, say, have some of the investments managed for you and done, you can go down the path that I was just talking about, where you can have the InvestSMART diversified capped fee portfolios and also the actively managed investments that Intelligent Investor have. But you might also want to buy and sell shares within your own brokerage account. And a lot of people talk to me about this and say that it keeps them active, they enjoy it, it keeps them mentally stimulated. What you could do is the Intelligent Investor has its research. So it talks about different companies along with its recommendations. So if you go to recommendations value investing, it will explain to you what the recommendations mean. So what is a speculative buy, for example. But let's jump into this example. So there was an article 16 hours ago that was published about Frontier Digital, FDV is the ticker code. And Nathan Bell has spoken a lot about this. So it's actually part of the growth fund that they listed that we were looking at just before. So he's written all the research here. So you don't have to go and read through all the market announcements or do the research yourself. And then they also talk about here on the right-hand side, the recommendations. So at the moment, it's a speculative buy at $1.26. And the current price is sitting at $1.27. So if you're someone who wanted to still keep active yourself, you could use the Intelligent Investor research and stock recommendation service and do that yourself. The other thing you could do is the Eureka report. Alan Kohler has quite a fantastic position where he, on a daily basis, chats to investors, chats to CEOs and founding managers of funds and companies and puts the hard questions to them. So he'll actually find out, Alan spoke just recently, if not today, it looks like it's been published. He's spoken to the CEO of AFT Pharmaceuticals. So if you're someone who's interested in that, you can get a behind the scenes look at what they've got to say. The third option is you can manage it yourself. So if you don't want any kind of investments managed for you, like the portfolios, you could do it all yourself, and you could use the recommendations that we spoke about and also the Eureka report again. They're the ways that we can help, that we would like to help you with your investment journey. But again, it's obviously up to you with how you go about it. So if we have to wrap it up and let you know what we would recommend, it's to always have a plan. And as part of that plan, you should be diversifying. You shouldn't be putting all of your money into one thing, whether that's, you shouldn't be leaving it just in the bank in one thing as cash. That's safe, but you're missing out on a lot of opportunity. If you do go ahead and invest in different assets, check out the fees. Remember that they will be a drag on your performance. If you've got a company that is saying it'll give you, 3% return a year, but then their fees are 1.5%, well, you're going to lose half in fees. So that compound return is severely diminished. So definitely keep an eye on that. And don't be afraid to ask for help. We have a lot of resources here. We've got the bootcamp, obviously. We've got the InvestSMART website with insights where we come out and talk about different topics. Paul Clitheroe, our chairman, who obviously writes for Money Magazine, he also writes for us as well. But there's nothing wrong with going to see a financial planner and getting a plan done or a statement of advice. And you can usually find financial planners that are willing to just one-off charge you for this. Try not to get caught up in ongoing uncapped fees with a financial planner. We've reached the questions part 2. So if you do have any questions, definitely go ahead and ask them now. I do have a question that's come through from Tony. And Tony asks, how would I invest a large amount of money in a type of future fund for grandchildren? And they age between 1 and 12. So that's a great question. Without getting too specific or too personal, it does come back to what we were talking about before. So a future fund, you want to think about, it does sound very long term. So that means that you could open yourself up to a longer term investment, a longer time frame. But at the same time, do you want to have a setup where you have some of it into a passive investment? So remember that I'm talking about the InvestSMART products here because I work for InvestSMART. and I'm familiar with these products, there are others that you can go up to tools and compare your fund to actually see other funds that you can compare against ours. I am a big fan of ours, obviously, because we do cap the fees, so the money stays in your pocket. But as an example, a very long-term type investment would be something like high growth. This one, you could have an element of a percentage, perhaps 80% of the funds inside a high growth. So at the core, 80% of the funds sit in that. But then on the satellites where they're active, you could put it into something like a growth fund. So as we spoke about, there's the growth fund here that Nathan Bell manages. It's purely every day on the lookout for stocks, Aussie stocks that are undervalued, and it's trying to outperform the market. Now, the beauty about our InvestSMART portfolios is that when you do open up an account, you can actually open them up for children, for other people. I'll just click on this, how it works, because I believe it talks about it here. So what you can do is actually do individual trustees for a child or joint trustees for a child, so 2 people. So if you wanted to do it for grandchildren or for a child under the age of 17, you can go through this process and you can set up multiple accounts for each child or each grandchild. All we need is identification from you, and that is through the website, and that's usually like a driver's license, and that's fairly easy done. It's all online. For the child, they don't have a driver's license yet, usually, so we just require something like a certified copy of the birth certificate or a passport if they're lucky enough to have travelled, and you can scan that to us and upload it or just email it to us, and that's all we need to get this one started. So you can definitely have that kind of approach. The InvestSMART portfolios offer that. We're looking at trying to get as well these kind of growth or actively managed portfolios in our professionally managed accounts. So at the moment, you can buy these through a broker. But what we're looking to do is, I think even as of next week, when you do set up an InvestSMART account, say for a child, you can allocate percentages to a diversified capped fee portfolio, and then also a percentage to something that's actively managed. So I hope that answers your question, Tony, but you're more than welcome to contact us either by phone or you can email invest@investsmart.com.au. And in saying that, what I'll do is I'll just check if there's any questions, because if you've got questions as well, you're more than welcome to email us at bootcamp@investsmart.com.au, and we'll help out where we can. But apart from that, it looks like we'll wrap it up. But congratulations, you've gotten to the last webinar, which would hopefully mean that you're about to or you have finished the content. And that's a great step. You're put yourself ahead of a lot of other Australian people who don't have as good financial literacy. The one thing we're definitely trying to improve here in Australia, Paul Clitheroe, our chairman, is on the financial literacy board for the government, and it's a big thing for him. It is for me personally as well. So if you do have any friends or family that you wanted to recommend Bootcamp to, by all means, please do. And you'll be asked to provide a survey response at the end of the bootcamp. I would greatly appreciate it if you could, just so as I could find out what I could do better, what I am doing quite well, or what else you might want to see in this content just to help other Australians. Until then, have a lovely rest of your week, and we'll talk next time.